Let me explain how the stock market works using Premier League footballers as examples. So you could invest into individual players just like you can individual stocks. So you may choose a socially responsible stock like Marcus Rashford. You may choose a stable dividend paying stock like Kevin De Bruyne. You may choose a stock that you think is going to be good and then flops like Werner. You may choose a hype stock like Saka, and so on and so forth. Alternatively, you could choose a manager who is going to pick these players. Just like in the stock market, you have active funds who pick individual stocks to try and beat the market. You can similarly have football managers who buy and sell players to obviously win trophies. So you can try an up and coming manager who's unproven like Mikel Arteta. You could choose a manager who's been at the top of his game for a while like Pep Guardiola. You could choose a manager who's done well in the past, but as we know, past performance doesn't mean future good returns like Mourinho. So you can see what I'm getting at here. You have individual stocks who are the players. You can then also choose a manager who's essentially going to try and pick and train these players. Or alternatively, you can take the managers out of the question and buy every single player in the Premier League through a Premier League index fund. It wouldn't require any research from you. It wouldn't require any manager involvement. You can simply invest into every player across the Premier League. And now this is essentially what an index fund is. Rather than you trying to pick individual stocks to beat the market, rather than choosing an active fund manager who is going to try to beat the market, you can essentially and simply hold the entire market. It's very passive, very hands-off, and take all that individual selection out of the process. So as you can probably tell by that intro, this video is going to be all about index funds. I hope that football analogy maybe made it a bit simpler to understand. But when it comes to the stock market, you have index funds and active funds, and you've also got passive investing and active investing, and that's why I'm going to dig a bit deeper into this video and hopefully show you how you can't beat the market and why passive investing is the best way to go. So passive investing is where you get the return of the market. Active investing is where you try to select individual stocks, or alternatively, you choose an active fund who's trying to beat the market. And that is the main difference. Passive investing and index funds, you get the market return, whereas with active investing, you are trying to beat the market. However, from countless studies and from countless books and research, the overwhelming majority of people, both individual retail investors like us and also active funds, cannot beat the market, especially over the long term. If we're going to be investing for 20, 30, 40, even 50 odd years, the chance of continually to pick individual stocks that beat the market, or an active fund manager to continually outperform the market, is next to zero. It's pretty much impossible unless you're a unicorn like Warren Buffett. And one big criticism that index funds get is you only get the average return, and I'm not average.
You serious?
Or something like that. And the thing is, in life, it's normally bad to be average at something. You want to be above average or excellent. But when it comes to investing, the fact is, if you are getting an average return of the stock market, you are actually outperforming 90+% of participants, because they are losing out because they're trying to beat the market by selecting individual stocks, or they're using active funds which have high fees which erode their returns. Now I'm not going to lie, some active funds do beat the market, very few do over the long term, but some will beat the market. But the fact is, you've got to try and pick the active fund that can continually do that. But as a stat for you, 96% of active fund managers cannot beat the market over a 15-year period or more.
Quick maths.
I'm only 23 and I'm going to be investing for 50 years. If I can get the market average, which is after inflation, normally around 7%, over 50 years compounded, that is going to make me a multi-millionaire, and there's no luck involved with trying to pick the best next hot stock or trying to pick the best next top active fund manager.
Hey, that's pretty good.
Not only that, but I think another reason why index funds and passive investing is so much better, and hopefully I'm convincing you here, is that it's very hands-off, very passive. You don't need to do anything. You can set up a monthly automated payment into an index fund. My personal approach is a global index fund, and that's all you got to do. It'll take you 10 minutes. You can maybe check it once a quarter, once a year, in case you want to rebalance everything. But for me personally, I have one global index fund, pretty much, that I invest into. Most of my money's in that on Vanguard's platform, and I don't need to check it whatsoever. It's hands-off and it's passive. Another great thing about index funds, which I touched on briefly, and about passive investing, is that a very low fee. You can invest into the S&P 500 through the VUSA ETF for 0.07%. You can invest in a global index fund or ETF for about 0.25%.
Quick maths.
If you're using active funds, the fees can get 1-2% plus. It doesn't sound like a lot on the surface, but go into a compound interest calculator and change your, say, average return from 7% over 30 years to 6% or 5%. It only seems like 1%, it seems minuscule, but if you do that over 30, 40, 50 years, as I mentioned, you will literally lose out on tens of thousands of pounds, if not hundreds of thousands of pounds, which is why, as you can probably tell, I'm quite biased towards this, but I prefer passive investing and index funds over active funds and active investing. So hopefully by now, the football analogy has helped you understand a bit what index funds are, and you're convinced that passive investing and index funds are the way to go. Not only is it simpler and hands-off, it's less time consuming. Unless you're very, very interested in personal finance and investing, do you really want to be spending all of your time researching individual companies, listening to shareholder calls, reading financial statements, when you could just literally set up an automated payment into a global index fund or ETF every month and be done with it? You can then focus your free time on trying to build other income streams, trying to start a side hustle like I'm doing with Making Money Simple, or just spending time with friends and family rather than looking through numbers and trying to do discounted cash flow models. There's actually a funny clip of Charlie Munger saying that he doesn't think he's ever seen Warren Buffett use a discounted cash flow, and that is meant to be the best way to actually analyze companies, because you're looking at their free cash going forward, their free cash flows. Now we've got onto that, I just wanted to explain a bit more what an index fund actually is, and also the main pros and also the cons. I've touched on them pretty much already, but I'll just say that a bit more succinctly. So an index fund is a basket of stocks. So for example, you've got the FTSE 100, which is the largest 100 UK companies. You've got the S&P 500, which is the largest 500 US companies. You've also got global index funds now where you can track the all world index. And the point is, it's a basket, it's a diversified basket of companies. So rather than investing in, say, Apple or Microsoft, you can invest into the S&P 500, which includes the 500 largest companies in the US, and it means you are a shareholder in Apple and Microsoft indirectly through the S&P 500 index fund or ETF. And that is it in a nutshell. It's simply a basket of companies that tracks an index. Now, as I mentioned, I've touched on this already, but the main benefits are that it's diversified, it's low fee, and it's also very passive and hands-off. So the fact is that index funds and passive investing, it doesn't require a manager. There's not a crack team of analysts trying to research stocks and looking at the next economic trends and macroeconomic data. It's simply set up to buy and hold the index. There's no human intervention, and that is why they can offer such low fees, particularly through platforms like Vanguard. As I mentioned, the S&P 500 ETF they offer is 0.07%. It's pretty much as cheap as it can get. Whereas on the other hand, because active funds have so many more costs they need to cover, that is why they must charge these high fees. And a big thing for me is it's very passive and hands-off. I don't need to be checking it on a daily basis, even a monthly basis. I very rarely log onto my Vanguard account. I know that my transaction's going through, I'm buying a global index fund every single month, and I don't need to do anything more than that. And what it has shown, and the thing that actually determines investment returns, which is a really good book called The Little Book of Common Sense Investing, written by Jack Bogle, the founder of Vanguard and index funds. But what it shows is the things that actually determine investors' returns are fees. And if you underperform the market, it's normally by the fee. So if you're using an active fund and you lose out, say the market returns 7% over the long term and you've only got 5%, it's probably because you're being charged a 2% fee, and fees are often the difference between people get an average return and a below average return, which is why reducing them fees is so important. And it's also so easy nowadays because there's so many low fee brokers like Vanguard or zero commission brokers like Trading 212, and there's also so many low cost index funds and ETFs that we can invest into. 30 years ago, none of these options were available, and it would have cost us a lot of money to invest. In 2021, it is cheaper than ever and more than accessible than ever to invest. So there's really no excuse not to, even if it's just £20 a month.
Yesterday, you said tomorrow, so just do it!
The main con of index funds is, as I touched on that early on in this video, is that you only get the market return. But I just want to emphasize, getting the market return over the long term is normally 7 or 8% after inflation. Even if we're pessimistic and we say there's been such good returns in this century so far, you know, since the 2008 crash, even if you only get 5%, if you compound that 5% over years and years and years, you will pretty much guaranteed become a millionaire over the long term. And I know a lot of people say to this, oh, why would I want to be a millionaire in 20, 30, 40 years time? What is the point?
What a stupid question.
I mean, I'd certainly rather be a millionaire in decades time by investing smaller amounts today than still having absolutely nothing to show for myself in 30 years time and still be living paycheck to paycheck. The point of investing is one day you can live off of those investments. By making small in monthly investments today, you're essentially buying back your time in the future as them investments grow over time. I personally believe the global stock market is going to be a lot higher in 30 years time than it is today, which is why I use global index funds and invest into those monthly. The real sort of complex is investing for the long term and guaranteeing yourself to becoming a millionaire whilst trying to increase your income today so you can enjoy yourself, you know, get a nice car, go traveling, spend time with family and friends, that sort of thing. That is sort of the thing that we need to try and work towards, where we're guaranteeing and locking in our long-term wealth by investing into diversified index funds for the long term whilst increasing our income for today. But to bring it back to the topic of today's video, index funds, what I'm trying to get to the point is they're diversified, they're low fee, and they're very passive and hands-off, which for me personally is the best and easiest way to invest for the long term. So the actual con of only getting an average return, I actually don't view it as a con. You're essentially saving time by trying to research stocks, and even if you did spend your time researching stocks, it would still be nearly impossible to beat the market over the long term. There's so many things out of our control as investors. We don't work at a central bank printing money. We don't work at a hedge fund with access to these insights and who can personally speak to CEOs. We are very, very restricted as retail investors. All we really have is the financial statements and shareholder calls. And at the end of the day, even though I personally do own a few individual stocks, most of my money is in either global index funds or S&P 500 funds, and I invest monthly for the long term. That wraps up this video. So hopefully by now you're convinced that index funds and passive investing are the best ways to invest. If you have any questions, leave them in the comments and I'll do my best to help you out. Of course, there is nothing wrong with picking individual stocks or active funds. It's complete personal preference, but I do believe that for the average person who's maybe not that interested in, you know, doing research and spending loads of time managing their money, they can simply set up an automated payment into an index fund every month and be done with it and let their wealth grow over the long term.
Yesterday, you said tomorrow, so just do it!
And I'm being slightly hypocritical because I do own some individual stocks, but the majority of my portfolio is in index funds or ETFs. And I would say to people, even if you are really passionate and interested in picking stocks, just make sure the bulk of your portfolio is still in index funds or ETFs, because that way you'll still be guaranteeing your long-term wealth. And if one of them individual stock picks does go to pot, luckily you've got that index fund backbone that'll be propping you up over the long term. Once again, thank you again for watching, and I'll see you in the next video.